It's Friday the 18th of January 2019. I'm Steve Towers. Welcome to ITB. Let's get started. I have two cases for you this week. The first case is a decision of the Korean Supreme Court. It's called Samsung Electronics, and it concerns the imposition of Korean royalty withholding tax. Here's the relevant structure. A US LLC owned 100% of the shares in an Irish resident company. The Irish company owned various US registered patents. The Irish company licensed those patents to Samsung Electronics, a Korean resident company. The license allowed Samsung to use the patents in Korea. Under the Korea Island Treaty, zero source country tax may be imposed on royalties. However, a 15% royalty withholding tax is permitted under the Korea-US Treaty. The Korean tax authorities argued that the Irish company was interposed in order to secure the zero withholding tax on royalties. It argued that the Irish company was not the beneficial owner of the royalties under Korea's domestic law beneficial ownership concept. Instead, said the tax authorities, the royalties were beneficially owned by the US LLC, and therefore 15% royalty withholding tax should apply under the Korea-US Treaty. That beneficial ownership argument was accepted by the Korean Supreme Court. But the court's analysis under the Korea-US Treaty went against the tax authorities. I'll explain that in a moment. But first, if this situation sounds a little familiar, it's because we've been here before. The Korean Supreme Court in 2014 decided a similar case against the tax authorities. But the tax authorities have taken this recent Samsung Electronics case to the Supreme Court in order to try a second time. As I said, they've lost again. Okay, let me take you through the Supreme Court's analysis. And the first point I will note is that the Korea-US Treaty is a very unusual treaty. It's not constructed in the same way as the OECD and UN model treaties, and it contains a number of provisions that you don't find in those model treaties. The royalties article is Article 14. The term royalties is defined in Article 14.4a to mean payment of any kind made as consideration for the use of or the right to use copyrights, patents, designs, models, plans, secret processes or formulae, trademarks, or other like property or rights, or knowledge, experience, or skill, know-how. And Article 14.1 relevantly says this: the tax imposed by one of the contracting states on royalties derived from sources within that contracting state by a resident of the other contracting state shall not exceed 15% of the gross amount thereof. That highlighted phrase, derived from sources within that contracting state, is unusual. The corresponding phrase in the OECD and UN model treaties is arising in a contracting state. That phrase is undefined in the OECD model treaty, but it has a definition in Article 12.5 of the UN model treaty. In the Korea-US Treaty, the phrase derived from sources within that contracting state is defined in Article 6.3. royalties described in paragraph 4 of Article 14 for the use of or the right to use property described in such paragraph shall be treated as income from sources within one of the contracting states only if paid for the use of or the right to use such property within that contracting state. At this point, the tax authorities say, well, under the license, Samsung Electronics has been given the right to use the patents in Korea. Therefore, the royalties paid by Samsung Electronics must be paid for the use of or the right to use such property within Korea. But the Supreme Court said no. The patents are US registered, not Korean registered. According to the court, a patent exists as property in the jurisdiction where it is registered. Therefore, you can use or have a right to use a patent only in that jurisdiction, which is the US, not Korea. As I mentioned earlier, the Supreme Court decided a similar case against the tax authorities in 2014. But that wasn't the first time that this issue arose. In fact, in 2008, the Korean government tried to remedy this situation. Parliament amended the domestic income tax law to insert a provision which says that where a patent is registered outside Korea, but it is used for manufacturing or sales in Korea, then the patent shall be deemed to be used in Korea, regardless of whether or not it is registered in Korea. In this Samsung Electronics case, the tax authorities argued that the word use in Article 6.3 is not defined in the treaty, and therefore, in accordance with the equivalent of Article 3.2, it should take its Korean domestic law meaning, which is in accordance with the provision inserted in 2008. The treaty provision which is equivalent to Article 3.2 is Article 2.2, which relevantly says this: any term used in this convention and not defined in this convention shall, unless the context otherwise requires, have the meaning which it has under the laws of the contracting state whose tax is being determined. But the Supreme Court held that Article 2.2 cannot be applied in this situation. It said that the meaning of the word use in regard to patents is clear from the text of Article 6.3. As a patent exists as property only in the jurisdiction where it is registered, the use of a patent can only be in that jurisdiction. So, in terms of Article 2.2, the context otherwise requires. And so the court concluded that the royalties paid by Samsung Electronics were not treated by Article 6.3 as income from sources within Korea. That meant that Article 14.1 did not apply to the royalties. So, what happens then? Under the OECD UN model treaties, the answer would be go to the business profits article, and as the US LLC does not have a PE in Korea, the business profits article would provide an exemption from Korean tax. But as I said before, the Korea-US treaty has some unusual provisions. The business profits article, Article 8, uses the term industrial or commercial profits, which has a definition which excludes royalties unless derived through a PE in the source country. And there's no other income article in the treaty. But there is Article 4.1. A resident of one of the contracting states may be taxed by the other contracting state on any income from sources within that other contracting state and only on such income, subject to any limitations set forth in this convention. For this purpose, the rules set forth in Article 6 shall be applied to determine the source of income. That reference to "and only on such income" means that Article 4.1 provides an exemption from Korean tax for income which is not sourced in Korea under the Article 6 source rules. And therefore, the court concluded that the treaty exempts the royalties from Korean tax. Now, I must say that I have a residual concern about that conclusion. If the US registered patents may only be used in the US, then what was Samsung Electronics paying for under the license? It did not obtain a right to use the US registered patents in Korea because that's not legally possible. Then what did it receive for its payments? Let me take you back to the definition of royalties in Article 14.4a. It refers to the use of or the right to use patents, but it also refers to the use of or the right to use other like property or rights, or knowledge, experience, or skill, know-how. Would any of those terms apply in this situation? Well, you could argue that the phrase "other like property or rights" should not apply because there was no property or right in regard to the use in Korea of US registered patents. But what about knowledge, experience, or skill, know-how? Could the payments be fairly described as consideration for the use of knowledge, experience, or skill, know-how? After all, a patent relates to an invention which is the product of knowledge, experience, and skill. If that's correct, there could be an interesting result under the Article 6 source rules. Here's Article 6.3 again. Note the highlighted words, "for the use of or the right to use property described in such paragraph." Arguably, the phrase in Article 14.4a, knowledge, experience, or skill, know-how, does not refer to property. If that's correct, then Article 6.3 does not set out the source rule for consideration for such items. Instead, I would think you would go to the residual source rule in Article 6.9, which relevantly says this: the source of any item of income to which paragraphs 1 through 8 of this article are not applicable shall be determined by each of the contracting states in accordance with its own law. Which would mean that Article 14.1 would apply after all, and a Korean 15% tax may be imposed. The second case is called ULO Systems. It's a decision of the Delhi Income Tax Appellate Tribunal, and it concerns the definition of PE in the India-UAE Treaty. Let me set out the relevant parts of the PE definition in that treaty. Firstly, there's Article 5.1 in its familiar form. For the purposes of this agreement, the term permanent establishment means a fixed place of business through which the business of an enterprise is wholly or partly carried on. And secondly, there's Article 5.2, which relevantly says this: the term permanent establishment includes especially A, a place of management, B, a branch, C, an office, D, a factory, E, a workshop, F, a mine, an oil or gas well, a quarry, or any other place of extraction of natural resources, G, a farm or plantation, H, a building site or construction or assembly project or supervisory activities in connection therewith, but only where such site, project, or activity continues for a period of more than 9 months. I, the furnishing of services, including consultancy services, by an enterprise of a contracting state through employees or other personnel in the other contracting state, provided that such activities continue for the same or connected project for a period or periods aggregating more than 9 months within any 12-month period. Let me make a few introductory comments about Article 5.2. Paragraphs A through F are identical to the corresponding provision in the OECD and UN model treaties. As you know, there's a statement in the OECD and UN commentaries that Article 5.2 contains a list of examples of situations which might constitute a PE, but they would do so only if the conditions in Article 5.1 are satisfied. In other words, Article 5.2 in the two model treaties has no operation apart from assisting with the interpretation of Article 5.1. But as you can see, Article 5.2 of the India-UAE Treaty contains 3 additional paragraphs, G, H and I. How should those paragraphs be interpreted? Are they also mere examples of situations which might constitute a PE under Article 5.1, or are they separate types of PE in their own right? Well, in regard to paragraphs H and I, previous cases in India have held that these paragraphs are not mere examples, but instead are separate forms of PE. And in my view, that's right. This present case concerns a construction project in India, and so paragraph H is relevant. You'll notice that paragraph H is drafted in a materially different way from Article 5.3 of the OECD Model Treaty. The drafting of Article 5.3 is consistent with the OECD's interpretation that Article 5.3 does not establish a separate form of PE, but instead it's a limitation on Article 5.1. It changes the time condition for Article 5.1. But paragraph H in Article 5.2 of the India-UAE Treaty is not drafted as a limitation on Article 5.1. It's drafted in a way that's consistent with it being a separate form of PE. And so in this present case, the tribunal focused on 2 separate forms of PE, Article 5.1 and paragraph H of Article 5.2. Let me briefly refer to the facts in the case. The taxpayer, a UAE resident company, participated in a number of construction projects in India over several years. Its participation in each construction project lasted for between 6 and 9 months. It participated in only one construction project at one time. You'll remember that paragraph H requires that the project continue for a period of more than 9 months. Faced with these facts, the Indian tax authorities made 2 arguments. The first argument was that each construction project caused the taxpayer to have a PE in India under Article 5.1. Each construction project was located at a specific place. That place would satisfy all of the conditions for Article 5.1 to apply. A specific geographical place, which is at the disposal of the enterprise for a sufficiently long period of time, and through which the business of the enterprise is wholly or partly carried on. In regard to the time condition, as you know, the OECD commentary indicates that 6 months would generally be long enough. However, the tribunal held that Article 5.1 cannot apply in this case because it is excluded by paragraph H of Article 5.2. In other words, the specific provision in regard to construction projects, paragraph H, excludes the general provision, Article 5.1, which is a very interesting view, particularly having regard to the fact, as we will see, that the tribunal concludes that the conditions for paragraph H to apply are not satisfied in this case. I'm not aware of anything in the OECD or UN commentaries which discusses this issue of a specific provision excluding the operation of a general provision. Of course, as you know, there's a relevant Latin maxim. I won't try to pronounce it. That maxim has been used in previous Indian tax cases to allow a specific provision to exclude a general provision. The tax authority's second argument relates to paragraph H. Remember that the time spent by the taxpayer on each construction project was between 6 and 9 months. And remember that paragraph H requires that the construction project continues for a period of more than 9 months. The tax authority's argument was that paragraph H should be interpreted as applying where the taxpayer carries on a different construction project each year. In other words, the time spent on all construction projects should be aggregated, which would then push the taxpayer over the 9 months threshold. As you would expect, the tribunal rejected that argument on the basis that paragraph H is not drafted in that way. It's drafted in the singular, a building site or construction or assembly project, or supervisory activities in connection therewith. The paragraph requires that each construction project be considered in isolation. And so the tribunal concluded that the taxpayer did not have a PE in India. If you would like to obtain a copy of this decision, please go to our website. The OECD has released a new report and database. According to the OECD's press release, the report and database provide internationally comparable statistics and analysis from around 100 countries worldwide on 4 main categories of data: corporate tax revenues, statutory corporate income tax rates, corporate effective tax rates, and tax incentives related to innovation. To access the report and database, please go to our website. And the OECD has announced that its next Tax Talks webcast is scheduled for Tuesday, the 29th of January at 3 p.m. Paris time. To register for the webcast, please go to our website. In China, the government has announced tax cuts for small and low-profit enterprises, effective for 2019, 2020 and 2021. In regard to enterprise income tax, with respect to taxable profits of 1 million RMB or less, enterprise income tax will apply to only 25% of such taxable profits, and the tax rate will be 20%. This means that the effective tax rate will be 5% for such profits. And with respect to taxable profits between 1 million and 3 million RMB, enterprise income tax will apply to only 50% of such taxable profits, and the tax rate will also be 20%. This means that the effective tax rate will be 10% for such profits. And in regard to VAT, the amount exempt from VAT for small-scale VAT taxpayers has been increased from 30,000 RMB per month to 100,000 RMB per month. For a copy of the government announcement, please go to our website. In India, the Mumbai Income Tax Appellate Tribunal has decided a case which applies the Most Favoured Nation clause in the protocol to the India-France Treaty. The case is called Entertainment Network. Service fees were paid by an Indian resident company to a French resident company. Prima facie, the fees satisfy the definition of fees for technical services in the India-France Treaty. That definition does not require that the service provider make available technical knowledge, etc., to the service recipient. However, under the Most Favoured Nation clause in the protocol to that treaty, the scope of the fees for technical services definition was narrowed by the subsequent signing of the India-UK Treaty. Effectively, the make available condition, which was included in the India-UK Treaty, was imported into the India-France Treaty by virtue of the MFN clause. The service fees paid to the French resident company did not satisfy the make available condition, and thus they were not fees for technical services. For a copy of this case, please go to our website. In Indonesia, the big news story this week is the government's release of a regulation on the taxation of Indonesia's booming e-commerce sector, particularly in regard to small and medium-sized businesses. The key revenue threshold is 4.8 billion rupiah, which is about $340,000. For online sellers whose annual sales revenue is below that number, they must pay income tax at the rate of 0.5% applied to their gross sales revenue, but they are not required to charge and remit VAT. For online sellers whose annual sales revenue exceeds that number, they must pay income tax at the rate of 25% applied to their taxable profits, in other words, on a net basis, and they must charge and remit VAT on their sales. Not surprisingly, online marketplaces have been given reporting and tax collection obligations in regard to online sellers. The regulation will be effective on the 1st of April 2019. For a copy of the regulation, please go to our website. And in Malaysia, the government has issued regulations and rules in regard to the tax position of Labuan, as announced in the 2019 budget. Firstly, under regulations which are effective the 1st of January 2019, Labuan entities which undertake specific activities will be required to comply with economic substance conditions. For example, a Labuan fund manager will be required to have a minimum of 2 full-time employees in Labuan and to have a minimum annual operating expenditure of 100,000 Malaysian ringgit, which is about $25,000. Labuan entities which do not comply with the economic substance conditions will be subject to the regular Malaysian income tax. And secondly, under rules which are also effective the 1st of January 2019, there are significant caps placed on the deductibility of expenses paid by Malaysian residents to Labuan entities. This change reflects the significant use of Labuan to base erode the regular Malaysian income tax. Specifically, these percentages will be non-deductible. 33% of interest expense paid to Labuan entities, 33% of lease rental payments to Labuan entities, and 97% of all other payments to Labuan entities. For a copy of the regulations and rules, please go to our website. The European Court of Justice has decided a case on the VAT treatment of barter transactions on referral from Finland's Supreme Administrative Court. The case concerns a demolition company which enters into two types of contracts with its clients. The first type of contract is called a demolition contract. Under this type of contract, the demolition company, ACO, agrees to perform demolition services for the client. This is item 1 in the diagram. The contract states a monetary fee for the performance of those services, item 2. Part of the demolition services is the removal of scrap metal and waste materials. ACO takes title in the scrap metal and waste materials, item 3 in the diagram, and is generally able to sell those goods to third parties. ACO tries to estimate in advance the quantity of scrap metal and waste materials and the price likely to be obtained on their sale. ACO factors in that estimated price when preparing the quote for the demolition services. However, the estimated price is not discussed or fixed with the client. The issue for the court was whether, for VAT purposes, there is only one transaction, supply of demolition services, or instead two transactions, supply of demolition services and supply of goods, being the scrap metal and waste materials. The court held that there were two transactions. The first transaction is the supply of demolition services by ACO, item 1. The consideration for that supply is the aggregate of the monetary fee, item 2, and the value of the supply of scrap metal and waste materials, item 3. That value is determined by the amount which ACO took into account when quoting the price for the demolition services. And the second transaction is the supply of scrap metal and waste materials by the client, item 3. This will be a taxable transaction only if it is made by a VAT taxable person. Assuming it is, then the consideration for that supply is the amount which ACO took into account when quoting the price for the demolition services. The demolition company also enters into a second type of contract, which is called a purchase contract for dismantling. Under this second type of contract, the demolition company, ACO, purchases from a client old machines and equipment, item 4 in the diagram. The purchase contract states a price for the purchase, item 5. Under the purchase contract, ACO is responsible for dismantling and removing from the client's premises the old machines and equipment, as well as disposing of the resulting waste, item 6 in the diagram. ACO estimates in advance the cost of the dismantling and waste disposal activities. That estimated cost is factored into the price it quotes for the purchase of the old machines and equipment. However, the estimated cost is not discussed or fixed with the client. And I might say that the court's analysis of this second type of contract essentially follows its analysis of the first type. And so the court was faced by the same issue as for the first type of contract. For VAT purposes, is there only one transaction, supply of old machines and equipment, or instead two transactions, supply of old machines and equipment, and supply of dismantling and waste disposal services. The court held that there were two transactions. The first transaction is the supply of old machines and equipment by the client to ACO, item 4. This will be a taxable transaction only if it is made by a VAT taxable person. Assuming it is, then the consideration for that supply is the aggregate of the purchase price, item 5, and the value of the dismantling and disposal services, item 6. That value is determined by the amount which ACO took into account when quoting for the purchase price. And the second transaction is the supply of dismantling and waste disposal services, item 6. The consideration for that supply is the amount which ACO took into account when quoting for the purchase price. For a copy of this case, please go to our website. As expected, the European Commission has launched a proposal to move from unanimity to qualified majority voting, QMV, on tax matters. Interestingly, it proposes a gradual four-step transition to QMV. For a copy of the documents issued by the Commission, please go to our website. In France, the 2019 finance law has been enacted and held to be constitutional, and its measures are generally applicable from the 1st of January 2019. As you would expect, the law is full of ATAD 1 implementation. But apart from that topic, a few other items caught my eye. The patent box regime has been amended to make it compliant with BEPS Action 5, and the preferential rate has been reduced from 15% to 10%. There's an anti-abuse rule in regard to outbound royalties. Subject to conditions, the payer's deduction for outbound royalties will be reduced if the royalties are paid to a company which benefits from a regime which is considered harmful by the OECD. And yes, the law introduces interest limitation rules in accordance with ATAD 1, but it imposes a greater amount of interest limitation if the company is thinly capitalised. In Italy, the 2019 budget law has been enacted, and its measures are generally applicable from the 1st of January 2019. It contains a number of interesting items which are unrelated to the ATAD 1 implementation. First and foremost, of course, there's the digital services tax, which I covered in last week's ITB. There are changes to the R&D tax credit rules, which might limit the amount of the credit. There's an extension of the so-called hyper-depreciation to 2019, and in some cases to 2020. A reduced corporate income tax rate of 15% can apply to profits reinvested in the acquisition of new assets or to increase employment. The notional interest deduction is abolished. There's a new window for companies to elect to step up the tax basis of business assets and qualifying shareholdings. And in regard to VAT, there are no changes to VAT rates for 2019. Also in Italy, the tax authorities have issued a ruling on the carry forward of tax losses following a reverse corporate merger. For a copy of the ruling, please go to our website. In Poland, the government has now issued a decree which defers the introduction of new withholding tax restrictions for outbound dividends, interest, and royalties. I previously covered this topic in ITB prior to the government issuing the decree. The deferral is generally to the 30th of June 2019 for all such payments. although there are some limited payments where the deferral is currently indefinite. And in Romania, the new quarterly tax on financial assets of banks, the so-called greed tax, has been introduced from the 1st of January 2019. I told you about this controversial new tax in ITB on the 21st of December. The new tax is imposed at progressive rates, which range from 0.1% to 0.5%, depending on the level of ROBOR, the Romanian interbank interest rate. In Mexico, there is speculation that 2 recent government decrees will be subject to constitutional challenge. The first decree includes provisions which prevent taxpayers from offsetting taxes, such as income tax and VAT, against each other. The second decree provides for income tax and VAT incentives for certain taxpayers located in Mexico's northern border region. I covered this initiative in last week's ITB. According to commentators, both decrees are susceptible to constitutional challenge. The first decree because the prohibition on offsetting taxes violates taxpayers' rights, and the second decree because it excludes maquiladoras from its scope. Also in Mexico, the government has issued a decree which provides tax incentives in regard to certain debt and share investments. In regard to debt, there's an effective exemption from interest withholding tax on listed domestic corporate bonds, subject to conditions. And in regard to shares, there's a reduced 10% income tax rate on profits from the sale of shares in connection with an IPO, also subject to conditions. For a copy of the government's decree, please go to our website. And in the US, the final regulations on the Section 965 transition tax have been issued, with no major changes from the proposed regulations which were released in 2018. For a copy of the final regs, please go to our website. And now for this week's treaty developments. And this has been a very slow week. All we've had is just one treaty signed. I have 2 articles for you this week. The first is called Digital Battlefront in the Tax Wars. It's written by Ruth Mason and Leopoldo Parada, and it's published in Tax Analyst's Worldwide Tax Daily. This article considers whether the EU's proposed digital services tax and the similar unilateral taxes proposed in the UK, Italy, and France would violate EU law, in particular in regard to state aid and prohibitions on nationality discrimination. Their conclusion is possibly yes, they would. The authors write this: the very large revenue triggers in the various digital tax proposals guarantee, as they were meant to, that digital taxes will fall disproportionately on US headquartered companies. The revenue triggers are facially neutral. They formally burden neither nationality nor familiar proxies for nationality, such as tax residents. Nevertheless, They are so high that the taxable population is very likely to be mostly foreign when viewed from the perspective of any one member state applying the digital tax. Domestic companies liable for digital taxes are likely to be foreign parented rather than domestic parented. As we explain, that effect might violate EU law as nationality discrimination. Likewise, selective features of unilateral digital taxes may violate the state aid rules. Now, you might be wondering how a tax can provide a selective advantage, which is necessary for a state aid claim. The authors explain it in this way. Unilateral digital taxes, such as the Spanish DST, are susceptible to state aid challenges because they are selective on the basis of size, nationality, and sector, each of which generally suffices for a successful state aid claim. A selective tax on big companies earning certain types of income can be understood as a selective subsidy to their competitors. The second article is called The Changing Landscape of the EU VAT, Digital VAT Package and Definitive VAT System. It's written by Alexandra Ball and it's published in the IBFD's European Taxation Journal. If you're not an expert in EU VAT and you're looking for a good, straightforward explanation on the major changes underway in regard to EU VAT, then this is the article for you. It describes in simple language the two major changes currently underway, the Digital VAT Package and the Definitive VAT System. In regard to the Digital VAT Package, the author writes, the Digital VAT Package covers a wide range of electronic commerce transactions in B2C settings. It seeks to amend the VAT rules applicable not only to supplies of electronic services, but also to distance sales of goods and importation. The Digital VAT Package consists of one directive and two regulations. The member states have to implement the new provisions into their national legislation by either 2019 or 2021, depending on the relevant provision. In regard to the Digital VAT Package, the article covers these topics. I won't read them out. Please hit the pause button if you'd like to study the list. In regard to the Definitive VAT System, the author writes, the Definitive VAT System, a European Commission proposal, represents the largest reform of EU VAT rules in a quarter of a century. It seeks to replace the current transitional system for intra-community cross-border trade with definitive arrangements. The transitional system is complex and leaves the door open to fraud, as it allows for the purchasing of goods VAT-free in other member states. On the 4th of October 2017, the Commission presented a set of legislative proposals to fundamentally change the current VAT system. Realising that implementing the Definitive VAT system will be a time-consuming and lengthy undertaking, the Commission has proposed 4 quick fixes to improve the day-to-day functioning of the current VAT system until the definitive regime has been fully agreed and implemented. The ECOFIN Council approved these 4 quick fixes on the 2nd of October 2018. In regard to the Definitive VAT system, the article covers these topics. Again, I won't read them out. Please hit the pause button if you'd like to study the list. Well, that's the way it is this Friday, the 18th of January 2019. I'm Steve Towers. Have a great weekend.